Welcome back to Financial Clarity for Doctors, everyone. This is Rachelle Vanderzanden here with Corey Janoff.
Hello.
Yep, we're both here, like always. Today, we're going to talk about a very basic concept that we haven't ever tackled before, but it's basically the idea of how do you know how much stock is worth? And it's a much more complicated question than you would think, but obviously, there's going to be some complications there. And it's not necessarily something we can, well, it's not something we can predict, but it's something we can understand a little bit better, which I think can be really helpful, especially if that's something that you want to try out, or if we just want to think about why is this maybe not a good idea. Sometimes we skip really far ahead, but today we're just going to back up and go into that basics. Um, I think a lot of times it's just like, let's invest. Let's put it in there. Let's see what happens. Let's give it long enough and it'll be okay. But when you invest in the stock market, what are you investing in? Like, what are you actually buying? And how do you know it's really worth anything? And that's a big question, I think, for a lot of people, but other people don't care at all. And I think that there's both of those peoples in the investing world. So we're just going to go into it a little bit just to provide some more detail.
Yeah. And I think
Yep,
there's a difference between investing in the overall market and investing in individual stocks. An
absolutely.
individual stock, trying to predict what a value per share should be of a company's stock is a lot different than the aggregate value of all the companies in the market or in whatever index you're looking at.
Mm-hmm.
But still, sum of all parts essentially. Um, but yeah, I think this all started from your nephew, right, Rochelle?
Yeah. It was a couple of years ago, actually, but over a holiday dinner, my nephew and I, he's brilliant, by the way, but we got into a fairly heated conversation. He's like 16, and he was basically insisting that the world was going to be taken over by cryptocurrency, that no other financial stuff would really matter, that the US stock market was going to collapse because of cryptocurrency, because cryptocurrency would be king at some point, which what? I mean, those are two entirely different things. And the fact that he didn't even know that those were two entirely different things was a little astounding to me. But again, he's 16. He knows a lot about certain things and has taken no time at all to learn anything basic about other things. So, I mean, cryptocurrency aside, again, entirely separate conversation. The stock market itself and values of stock is based on investing in very real companies that sell products and provide services for a cost. So there's actual things that are transpiring behind the purchase of a stock. It's not just we're investing in this company because we think someday it's going to be worth money, or like it's not all on paper. There are actual things that are changing hands behind the scenes. And we invest in companies, and so we can own a tiny, tiny, tiny bit of that company so we can participate in the returns of those businesses. Sometimes, that company has value because it's earning money, and maybe they even give you a little bit of that money. Other times it's like, we think this company is going to keep growing. We think the stock price is going to go up. So we're going to go into a few of those basics. But realistically, a lot of this, we agree that things have value because someone is willing to pay you a price for it and you're willing to sell it for that price. So that's a huge part of it as well. But there's actual stuff going on. Like there's products, there's services, like Amazon is shipping things in trucks, and you're paying at the grocery store for your groceries. Like all of these things play into it as well.
Yeah, for sure. And there's kind of two, well, how do I phrase this? So the value of a stock in the short term, I think, is largely driven by human emotions and what their feelings are around the company, their expectation of what that company's short-term earnings or earnings growth will be. Um, Whereas in the long run, it all gets down to fundamentals. Is the company making money? If the company is making money and or growing in size, then that's going to drive the long-term value of the stock. But short term, it's anyone's guess. That's where I think a fun book to read it's almost a pessimistic view on the stock market, but I believe it's called The Number, which is basically about how stocks the most important number of all the different statistics and variables is analysts' expectations of quarterly earnings growth, and whether the stock value meets or falls short of or exceeds that analyst expectation. That's going to, cause those short-term pops or, dips every quarter, whether or not they met or exceeded expectations. But yeah, long term, if company's making money, like you as an owner will also make money. That's how the game works. But getting a little bit into the weeds here, like we've already talked about, when you buy a stock, you're hoping to participate in the potential growth and profits of the business. And, a mutual fund manager is doing this, selecting, different companies to look at or to invest in. There's a zillion different metrics you can analyze when it comes to valuing a stock. A common one that's relatively easy to understand is the PE ratio, the price to earnings ratio. And some could argue it's a rather outdated metric to look at based on historical norms, but regardless, it's still a decent one to consider. You take the price per share of stock divided by the earnings per share. So if there's, 4 million shares outstanding, whatever the total earnings of the company are, divided by 4 million, that's the earnings per share. And then you have the price per share. And yeah, it's, pretty simple. So how much do you pay for each dollar of earnings for that company? And companies that have higher PE ratios are expected to be growing more. More people are willing to pay more for each dollar of that company's earnings because they expect that earnings growth to rise. Whereas companies with a lower PE ratio might be considered to be of more value. Hey, I only have to pay $6 per share for this company's earnings growth, whereas Amazon is like $200 per share or whatever it is. So it doesn't necessarily, a low PE ratio doesn't necessarily mean it's a bad company to invest in. It could be a great opportunity because the market thinks it's undervalued and you could, get in at a good price, but it also might mean there's just not a ton of earnings growth. And maybe they, pay investors via dividends more heavily than they do in terms of growth. So, and if we're looking at averages, like right now, a lot of financial services companies, big banks and whatnot are having a rough time with, the recent rise in interest rates. But is this historical averages you put in here, Rachelle, or is this the
No,
current
it's like
number?
a current one.
Yeah, that's what I thought. Okay, yeah. So
Yep,
financial
yep.
services, like the large banks of the world, their stocks are trading at a PE ratio of about 5, whereas the tech industry is trading at a PE ratio of about 43. So you're paying $43 for every dollar of earnings that a tech company generates, whereas in financial services, banks, institutional companies and whatnot, you're paying $5 for every dollar of their earnings. Much better ROI with the financial services, apples to apples, but the expectation is these tech companies are going to grow a lot more than the financial services companies, and you're banking on that company's, the stock value going up more so than you are profits, if
Right.
that makes
So
sense.
there's two ways with stock ownership that you can actually make money. One is that you invest in a stock and they issue dividends to the stockholders, basically. So a dividend is you taking part in that profit. So the company generates profits. They don't need to necessarily reinvest it in their own company and continue to grow. So they distribute those profits to their shareholders. And a lot of people think of this as like that passive income. So when people are looking for passive income in their investments, a lot of times it might be like interest payments for bonds, it might be dividends from stock purchases and things like that. But most of the time, we don't actually see that money. Usually, especially if we're in like the growth phase of our savings, we have those dividends reinvested. And when the dividends are reinvested, that allows our portfolio to grow a little bit more. So that's one way that you can earn money by owning stock. And that happens more frequently with a lot of companies that have lower PE ratios, which is kind of weird. Like we're paying less as in terms of like that price per earnings that the company has, and we're getting some dividends. But the reason that we're paying less for that stock and that stock is maybe seen as having a little bit less value is because the other way you can make money by owning stock is if the stock price goes up and now we sell and now we have locked in a capital gain. So if you own a share of stock, which a lot of growth companies, they tend to grow over time more quickly. And so now if we own the share of stock, if the stock price goes up, if we like sell out of that stock and now we have that capital gain, we've made money as well. So it's like, what thing do you think is more reliable? What thing are you aiming for? Do you want something that's, more related to like what's actually happening behind the scenes? Or are you just investing for the sake of that potential future growth and that stock price appreciation? And the answer is that most people do both. And maybe not always across the board. Some people may lean more heavily into those value stocks because they really like the dividends, they really like the passive income. Some people are like, I just want my portfolio to grow. I'm going to lean on these growth stocks really heavily. But again, I think diversification can be really helpful. So most people own a little bit of each in their portfolios as a whole, especially if we're aiming for just a little bit of less risk and some additional diversification.
Yeah, and historically, the value versus growth argument or debate, value and growth stocks historically have performed about the same, but they're often mirror images of each other. If you're looking at a graph, years where growth stocks are doing well, usually value stocks are lagging behind, and vice versa. There'll be periods where growth stocks are struggling, and value stocks are doing well. The last, call it decade, large growth companies have driven the majority of the US stock market returns. And, recency bias. A lot of people say, well, why would I invest in these value companies or these small companies or anywhere else? Why not just large growth? As of late, that's worked well. Moving forward, who knows? It's anyone's guess. Like if we were recording this podcast 15 years ago, we'd be talking about emerging market stocks as the place to be. US stocks are dead, 2000 to 2000 and through 2009, it was the lost decade where literally US stocks started and finished at the same spot. There was, not counting for dividend reinvestments, there was zero growth in the stock market during that period. Now, when you zoom in, there was a growth spurt, a big decline, another growth spurt, big decline, or I guess it started off as a decline and then a growth spurt, but neither here nor there. You just never know moving forward what's going to do well. That's why we want to be diversified. Now we talked about dividends versus growth. What are we shooting for? What's more important? To each their own. One element that makes this all fun and exciting is human nature. Can't control human nature. So some amount, and this is where I talked in the short term at the beginning of this episode, some amount of a stock price is well, I guess the whole value of a stock is really determined by supply and demand. Are there buyers and sellers? Where do they meet in the middle? What's the agreed upon price? If there's more buyers than sellers, the price is going to go up. If there's more sellers than buyers, the price is going to go down. That's economics 101 until it finds that equilibrium where the buyers and the sellers agree, and they meet at that point. And that changes by the second in the stock market, if anyone's, paid attention to that. But things that can affect this: news cycle, what's going on in the world, people's sentiments. We'll get into it in a little bit about, I think, the GameStop saga. You could get a whole, bum rush of people that are all in on one company, and that can influence the stock price. You get some, bad news headlines, a corporate scandal, accounting issues, like weather. If there's a big
even economic conditions too, if the economy is doing poorly, if inflation is high, like even if it doesn't really affect the performance of a specific company, it might affect the whole stock market. The whole stock market may go down and most of the companies with it.
Yeah, the consumer sentiment, which, changes with the wind. So that's a really hard to predict element, and where I mentioned earlier, in the short term, that's going to influence the stock price a lot. Whereas in the long term, if the company's making money, their stock's going to do all right.
Yep, absolutely. I think we want to go through a couple of examples of where this didn't play out the way that most investors would have thought, you know, or the way that like the data shows. Like if we're looking at numbers, what do we think is going to happen? And then something completely different happens. So GameStop that Corey just mentioned is a great example because like the whole stock market was guessing that GameStop was just going to fail. Like it was not doing well. There were a lot of big players in the stock market that were betting against GameStop. We think that this company is going to go under. We think the price is going to keep going down. And then there was just this one person on the internet that was like, you know what? I think GameStop is going to do really well. And I think that we should be buying GameStop, not selling GameStop. So let's all buy it together. And he got a big enough audience and enough people started to say it that it became what's now known as a meme stock. I'm pretty sure that GameStop was like the beginning of meme stock. Is that your
Either
understanding,
them or
Corey?
AMC. And
Something
little
like that.
sidebar, what Rachelle just described is illegal. So do not
I'm
go.
not telling you to do it.
Yeah, do not go on online forums and hype up a company stock, because if you are successful in doing this, you'll find the SEC knocking on your door, and at the very least, probably have a big fine to pay. At the worst, spend some time in prison.
Yeah,
So
so lots of drama. That was my next bullet point. Was like this whole thing was loads of drama every step of the way. But yes, everyone coordinated buying this stock so that the price went through the roof. It basically started at about $1 a share in March of 2020. And then everyone started buying it in early 2021. Internet forums started picking up. Everyone started talking about it. And the price actually shot through the roof and peaking at a little more than $80 a share. So that's 80 times what the original price was. And then, as the SEC started cracking down, as all of these other things started happening, that price started to drop. People realized, okay, this is probably not a good strategy. And the price dropped to $10 a share in February of that same year. And then it spiked back up to $60 a share. I don't know, like every step of the way, exactly what happened, but there was a lot of just people joining in. And it became a thing where like they didn't even need to hear it from a specific person. It was on the news, it was like everyone was talking about it. Now everyone wants to buy it because everyone wants to do this thing that someone else did that they made a bunch of money and it was crazy. It just didn't make any sense because it had nothing to do with GameStop at all. It had nothing to do with GameStop about like how that company was doing financially, whether they were going to make profits in the future. It was just who's going to buy this, who's going to sell this. It's becoming really popular to buy it. And then now it's trading around $14 a share. So it's still significantly higher than when it bottomed out. And I think that there's lots of people on both sides of this that are like, oh, they're going to do better now just because they got so much attention. It was like, maybe no news is good news sometimes, but also free publicity is great. So GameStop got a lot of that out of this whole drama. So that happened as well. So it's, there's so many things that are out of our control. And, we, a lot of people that participated in this lost a lot of money too. Like you get really excited about something. You see that this price went from $1 to $80 a share, and you're like, it's going to keep going up. And you buy at 80, and then it sinks down to 40. And now you're like, okay, now I have half the money that I had before. And so there are games people play in the stock market all the time, day trading and things like that. But there are lots of losers. You just hear about the winners more. And so I think that's important to keep in mind also.
And this is a perfect example of different games being played in the stock market that you alluded to, Rochelle. I don't know if it's Morgan Housel that's mentioned before. The stock market is a place where people come together, people who are playing different games with different rules all come together and are playing on the same playing field. And it drives people nuts because oftentimes what happens goes against conventional wisdom. But this perfect example, like a long-term investor has zero business investing in GameStop because, like, if you're familiar with GameStop, you could argue there's zero reason why they should even be in business still. But that's neither here nor there. It's kind of like the death of the shopping mall type of analogy. You can order your games online, you can digital downloads like buying video games or other games at a actual retail store, it's, it doesn't make sense in today's day and age. But the company could, I don't follow them closely enough, but they, I'm sure, could pivot and find ways to continue to thrive as a business potentially. But neither here nor there. You've got long-term investors and you've got day traders, and the people participating in this meme stock craze. It's like, they don't care if a company is profitable, if the company is making money, what their business operations is. All they care about is if someone else a few hours or a few days later, or even a few minutes later, is willing to pay more per share than they bought the stock for. Like, if I can buy it at $60 a share and sell it to you this afternoon at $62 per share, and if I can repeat that over and over and over and over and over again, I'll make a lot of money. If I can just bank a $2 a share profit in a matter of hours, that's a good way to make some money. It's also a good way to lose some money if it goes the other direction. So, but you have different people playing different games, high frequency trading, and it's not a matter of, what's this company actually worth? It's trying to predict the supply and demand. Is there going to be more demand than supply, and are people willing to pay more than this? It's kind of like flipping houses, that I think has lost some favor recently, just due to real estate prices and interest rates. But 10 years ago, it's like, oh, let's buy a house, rehab it, sell it, a couple months later for 50% more than we paid, and make money that way. Easier said than done, but it's the same exact analogy. Is, can we buy this, hold it for a short period, and sell it to someone else for more than we paid? That's all it is.
Yep, exactly. I think that we have one other example that we wanted to go through here of one that where it doesn't really match up, like what people are paying for stock versus like how much profit a company is making and things like that. But it's a completely different type of example. So the second one we're going to talk about is the IPO of Beyond Meat in May of 2019. So for an IPO, which is an initial public offering, this is the first time that stock is available on a publicly traded market for someone to buy of a specific company. Usually when this happens, there's a target price that's set. Like, we think that this company is worth this dollar per share, and then they list it, and then the stock price goes up or down. Like, does the market as a whole think that this company is worth more or less dollars per share than they estimated? And then when Beyond Meat went into the market, it was set at $25 per share. That was the target price from the company. And when it was listed, the stock actually shot through the roof. Like, throughout the day, it kept going up and up and up. And there was a 163% increase immediately. So that first day, the stock price closed at almost $66 per share. People were excited. Like, this was the first time that we were seeing this fake meat, which was really exciting to people for lots of different reasons. Like, either they thought it was better for their health, they thought the technology was really cool, they thought that, this was a big deal for environmentalism. And there are lots of people who have really strong convictions about the environment and what we should be doing for the environment. So there were people that wanted to take part in this stock because of the technology. There were people that thought that, maybe they wanted to move away from a meat-based diet. Maybe they were really excited about the environmental implications. There were so many different people that were buying this stock for lots and lots and lots of different reasons, but everyone was excited about it. And I had clients who wanted to invest in the stock because they believed in the mission, but it's not necessarily a good reason to buy a share of stock.
Well, and there's also, I think, the subset of people like with the GameStop one that are buying it because they think
they're playing a game.
People are going to be wanting to pay more, the environmentalists, the vegetarians, etc. So you have that pool of people coming in to try and make a quick buck as well.
Yep. And the price actually peaked in July of 2019. So, 2 months later at $235 a share. So far above and beyond what the target price was. And the target price was driven by numbers and, analyzing potential profits and all of these kinds of things. The share price that it reached had nothing to do with that, like zero to do with that. Now, in October of 2023, when we're recording this, it's trading at a little over $8 a share. So everyone that bought this company because they believed in the mission, like, I think those folks kind of lost in this particular scenario if they held on to their stock long enough, because some things happened that Beyond Meat couldn't necessarily control, and that individual retail investors obviously couldn't control as well. But, they may have been the first company with some brand name recognition that was demonstrating this technology, but they are definitely not the only one at this point. Maybe not even the best one, which is obviously, an opinion, not a fact. But there's lots of different companies that are out there that are doing the same things. And it's a good way to demonstrate just that the first company that does something may not always be the most successful company at doing that. And I think that can be true across the board, especially with technological advances. Like just because it's the first company that did it doesn't mean it's going to be the company that does it the best. So we can be really excited about new technologies, but not necessarily put all of our money, all of our, hopes and dreams into this one company being really successful. Yeah, so I think it's definitely something to consider. We don't want to get too excited about new technology. Obviously, we should be excited about it, but maybe not with our money. Maybe we can play around with a little bit of money and not put too many resources towards examples like that.
Well, and success and best, and like these are all subjective terms. Like, how are we defining what the best company is or what the most successful company is? Is it that who makes the best product? Is it who makes the most flavorful plant-based meat? Is it who has the most efficient business operation that can, keep their overhead costs low and crank out profits? Maybe not the highest quality product, but a okay product, and they can make a lot of money on it. Like a lot of subjectivity here on how, who's, when it comes to what product or service is the quote unquote best, and does that translate to company profits and company longevity and staying power within that industry? So a lot to think about here, and and this is one of the big reasons why all these variables, why we don't really recommend investing in individual stocks to our clients, because you just don't know. There is so much out there. And if you look at the data, the average stock return over time, like if you look at, the aggregate of all the individual stocks out there that have traded publicly over time, what the average return of them is, it's like half of what the actual stock market index return is. So if you just buy the entire index, like odds are you're probably going to get almost double the returns of trying to buy individual stocks. Just because companies lose flavor, go out of business, merge, get acquired, go bankrupt, whatever, and then new companies come in and replace them. So, owning the whole market, allows you to participate in the winners, but also, you're not overly exposed to the losers either.
Yep. Because figuring out the appropriate price for a stock, it's not simple. It's not predictable. So, and even when you think you have an advantage, someone else has a bigger advantage. As a retail investor, you just don't have the biggest advantage out there. You just don't. So, in summary, I think, this price is a combination of things like company earnings and investor expectations. And humans are investors. Humans have feelings and emotions. And that makes this less predictable. It's not like physics. It's not like math. Like NASA can launch a rover to Mars and calculate within the hour when it will land. As long as you have all the correct formulas, all the correct data, they can launch a giant space telescope with like 900 failure points and still get it into space because they have math on their side. And, even in those scenarios, they can potentially have a failure. But this is not like that. This is not just math. There's a famous physicist, Richard Feynman. Corey looked up this quote, but imagine how much harder physics would be if electrons had feelings. And they don't, luckily, or else we'd be in trouble. But but we do. And like we're the ones buying and selling all of these stocks. So we can talk all day about the valuation of stock purchases. And I think it's helpful to understand those things. But when you introduce human nature, all bets are off. Like we're not going to automatically be able to know if something is a good price point, basically.
Yeah, it's difficult. Mm-hmm. Yeah, when you're investing in individual stocks, the price is where the buyers and sellers meet, and that can change, like change with humans' feelings, change by the day, change with the wind. The institutional companies or, the big banks out there, they're buying millions and even billions of dollars of shares where, you're buying pennies worth essentially in retrospect. So like you don't really have much control over what a stock value is going to be unless you hype up an internet forum, in which case you'll end up in jail if you're pumping up a stock price. So don't do that. But it can be fun. I am 100% on board with investing in stocks for fun. You got an itch, you want to scratch it. Let's throw a couple bucks in this company and see what happens. For whatever reason, whether you use their product, you like their technology, you like the service, you've got a brother who works there, you want to get on the meme stock craze and you think that you're getting in early and can, sell in a short term for more than you bought it for. Like I'm all for, going to Vegas, having fun in the casino too. Like just be responsible with it and, treat it like if you're going to be buying individual stocks and playing that game. Yeah, I would treat it like a play account. And, this is our fun money, but not necessarily our long-term investing money. And if you have a diversified portfolio with your long-term investing money, you will own those individual stocks that you are thinking might be winners. They'll only represent, 1 or 2% of your entire portfolio, but that's all you really need. Invest in a little bit of everything and, be patient, let time work its magic.
Yep. And investing in like a broadly diversified mutual fund portfolio, it might be a little boring, but it's boring because it's less risky, which if we're talking about your retirement money, we probably want to take on a little bit less risk. There's always some risk when we're investing in the stock market. We can't diversify that away. But, evening that risk out a little bit by not putting too much in individual companies is going to be really helpful for most people. Like some people win at this game. Most people don't. And even professionals often lose when they try to play this game. So I think, if you can separate like the fun and the long-term goals, that is a very good idea.
Well, that's all, folks. See you next time.
Thanks for listening.